And joining us for a further analysis on what's playing itself out on that market scene is Martin Smith from Anchor Capital. Martin, it's a pleasure. Good afternoon to you.
Thank you. How are you doing?
Wonderful. How are you?
Yeah, good, thanks.
All right, let's maybe see what's driving markets today. We know that the US is back online, so I am anticipating higher volumes and maybe even a bit of catch-up from that part of the world a little later, Martin. But for now, I'm just keen to get your thoughts on what we're seeing drive this performance up to halfway through the day.
Yeah, so I mean, you're right. We saw kind of a third of volumes before Thanksgiving weekend in the States last week. So couldn't really take too much information from kind of what we got from a market movement perspective there, although was mixed across various indices. But today we're seeing mixed and to slightly subdued trading in the Asian markets, and in South Africa also, like you mentioned, slightly down, a little bit mixed. I think we also need to remember that the market, both locally and kind of abroad, had a very, very big November from an uptick perspective. So I think catching its breath a little bit and waiting to see where the data points settle in the coming weeks.
Of course, yes, we have inflation coming out of inflation data coming out of the Eurozone and the US. Another week of watching this data. I think when we're not looking out for what the Fed is doing and saying, we're then looking out for the data. But all of it still pointing to this very complex inflation environment that we found ourselves in, Martin. I'm keen to get your expectations for this one.
No, you're right. I think it's a very tricky one because, yes, you've got this little bit of excitement about, okay, we are now at the back end of interest rate hikes and we'll see interest rate cuts probably in the second half of next year, specifically out of the States. But also, what does the economy there have to do for the Fed to justify cutting rates and potentially cutting them more aggressively, depending on which research house you look at? So there's two schools of thought. One is that money becomes cheaper again and things kind of tick up from there. The other one is that the economy starts to have a real downward dip, which is why they have to cut interest rates, and that's obviously very, very bad. So two schools of thought, which is probably why there's a lot of cautiousness still in the market, even though we have seen quite a big rally in the last couple of weeks.
Also interesting is what's happening with OPEC Plus. They moved their meeting, I think, from the 26th to this week, Martin. I'm wondering if that is something that happens often, maybe, that they would move a meeting. And if this speaks of any possible risks for us who are waiting to see what the price or what the production decisions will look like, just by virtue of them delaying the meeting by a few days.
So I think if you look at what oil has done, I think it's come off quite a bit in the last couple of weeks, and it speaks again maybe to what OPEC may or may not do, but also a little bit of concerns around global demand. So not necessarily just what the supply side is going to do, and I think OPEC have been quite tight in their supply and kind of kept it relatively in line with what the market's expecting without making any too kind of bigger moves over the last few years. But I think it's more around what the demand's going to do. And what the market thinks is going to happen from a demand side perspective. And again, coming back to the point where we see interest rates being cut, is it because you're seeing a bit of a recessionary environment or the economy being hit quite hard? And that speaks into what oil may or may not do. So lots of moving parts is kind of where I'm getting at.
And let's bring it back home and maybe look at some company results. Oceana came out today, I think a very impressive set of numbers. All of it speaking to a consumer that's battling, and Oceana being at the right place at the right time.
Yeah, absolutely. I think you mentioned at the beginning of the show that a cheaper protein source from the Lucky Star brand. Also feeding into that is the fact that you've had this avian flu come on board and a source of protein, not chicken, which has also been something to consider. But a very stellar kind of set of results from the business. It's also looking very cheap optically, about 2 standard deviations lower than its 5-year historical average from a PE perspective. So that's positive there. And I think it's one that looks quite interesting. And I think you maybe need to be a bit cautious around licensing and regulation, given the kind of nature of what they do. But other than that, I think, like you mentioned, stellar results, and I think a very, very good business.
What I'm also keen to get your thoughts on is Zida. Now, of course, it's Zida's first, reporting period, I think full reporting period after listing on the JSE, Martin. What's very interesting about them is when they listed, it seemed like the market wasn't quite clear on their investment case and on their value proposition, but this set of numbers is really strong. And I'm wondering if it might take some time for investors to have absolute conviction, but so far so good for Zida.
You're 100% right. I mean, this listed at about 18 rand or at 18 rand a stock kind of about a year ago, and it went all the way down to 12, and now it's about 13. So you're 100% correct in saying the market maybe didn't fully understand, didn't fully appreciate, or maybe thought that the multiple was too high on what they were offering. But this set of results, I think, starts the process of the market getting more comfortable around their numbers. Like you mentioned, very good set of numbers from a revenue perspective, from a HEVS perspective, and I think it might just be a wait and see to see how it settles. But having a nice recovery and starting to put the numbers on the board.
And then with Standard Bank, a voluntary trading update there. Not much detail in this one, Martin, but I think what stood out for me is credit impairments expected to moderate. Are we expecting all the banks to come out with some form of a moderation story, or will it really depend here, depending on their risk appetite at a time when credit is so expensive?
I think it will be a little bit of a wait and see. You're hoping that the kind of trend continues in some ways. But I think if you look at the Standard Bank results in general, I think it shows momentum is continuing with this business, have continued to do what they've been doing so well, and kind of what we saw in the last update that they sent out. You've also seen revenue growing faster than costs, credit loss ratio also improving. So a lot of metrics kind of moving in the right direction. It's a business we really like and have held on to for a while. And I saw nothing to suggest otherwise. So all good from a Standard Bank perspective.
And when it comes to Invicta, I'm keen to get your thoughts on that one. They've described their performance of robust. Martin, would you agree with that sentiment?
I think robust is the right thing. And I think it's not necessarily just the HEPS that we need to look at here, because that was kind of flat year on year, but I think it's more around the decent cash generation that we saw out of the business. I think that's very, very encouraging. Trading at about 50% discount, or sorry, 50% of their NAV. So looking cheap from that perspective as well. So I think a decent and robust performance all around. But again, I think it's more the cash generation side of it that was the most impressive for me.
Well, Martin, I'm keen to get your stock pick in a jiffy. But first, I'd like us to reflect on counters that did find favor with your industry peers.
Glencore for a number of reasons. First and foremost is they are almost 20% of their profitability is derived from trading commodities, not necessarily just digging it out the ground. So this volatility in the commodity market suits them perfectly. And then about a month or so ago, they finally bedded down that Canadian company Teck Resources, which is going to change their cash flow massively. The free cash flow gets a lovely hit after this deal. And as you saw with Sibanye a few days ago and a few other companies in our space, they're trying to shore up their balance sheets, but this deal for Glencore puts them in a nice space. And I think around these levels, it's round about 105, 106. Definitely offers good value.
I think I might like Sasol down to 200. I like Growth Point at the levels where it is at about 10 Rand at the moment.
Yeah.
And I do like Premier having just bounced off of that 20 Rand level. I think it is at attractive levels. So I've not given one, but I've gone ahead and given three because it's Black Friday and we're festive, right? The festive season is around the corner.
Fine, we'll forgive
But I'll do a bit of a detailed deep dive into some companies before the end of the year and give my expectations around next year as well. I remember I gave out a stock. I think it was PayPal a couple of months ago. And the stock bounced quite nicely off of $50. It's still sitting at $56. I'm not too fussed about that. So and I've said this before, a lot of stocks are at very good prices where you get in now, you're not going to be seeing that return immediately. Don't expect it to be the Occidental Petroleum that I gave out shortly around the time Warren Buffett got into that. But don't expect those sorts of movements now. Expect that values and stocks are at really attractive pricing, but you're going to be holding for a bit longer than what you were in the past.
As Richemont, it's still about 30% off its highs. Yes, and there are definitely some headwinds, still in the luxury space, especially out of China. But we've seen a lot of sort of, positive things coming out of China. The government's obviously stepping in, to assist the local market there. And I think, I don't know what the catalyst is going to be, but at some stage, I think the consumers are going to, start to get more optimistic, and that'll obviously be good for the luxury space. But we also see, that luxury sort of tends to be a little bit more resilient, when we see some of these more higher net worth consumers, not necessarily budging that much when it comes to, you know, interest rates going up and economies coming under pressure. So and it's just cheap at the moment. Cheap versus peers, underperformed the Swiss luxury index of late. So yeah, and I think it's a fantastic business.
All right, Martin, keen to get your thoughts on some of those counters. There's quite a few that flew around there. Glencore, Sasol, Growth Points, I think Richemont as well. Keen to get your thoughts here.
Perfect. So Glencore, I know the other analysts, they called it a buy. We actually sellers of it at the moment. I think if you look at what thermal coal prices have been doing and how much of Glencore's business that is, I think it's potentially not the right time to be owning it. And in fact, like I mentioned, we've been selling it across the business. So don't mean to go against the analysts that mentioned that earlier. Sasol was called a buy. It's quite a difficult one to call because optically it's looking very cheap. But if you look at it from a free cash flow perspective, sorry, it is actually looking expensive to kind of slightly in line. And you've also got this overhang with what oil prices may or may not do, specifically the fact that they've been quite weak lately. So I think it's quite a difficult one to get conviction on either which way. So I think that's I'll leave that one in the middle of the ground. And then Richemont, I do like on a long-term basis. At the moment, I think you are seeing kind of operational momentum moving in the wrong direction. I think you may see some downgrades, making it seem cheaper than it actually is or not seem as cheap as it actually is for right now. So I'd be cautious on it in the short term, but I do like it from a medium to long term perspective.
And which counter do you like overall today, Martin?
Can I be boring and say cash? I'm feeling very cautious at the moment.
That's fine.
I'm going to say cash. I know it's boring, and I haven't done it in a while. But for right now, after the move we've seen, I'm happy to be a little bit on the sidelines as at today.
Well, Martin, it's always a pleasure speaking to you. Thank you so much for your time this afternoon. Have a great week. That was your midday markets update with Martin Smith from Anchor Capital.